Well, we know that the Federal Reserve did. They increased rates yesterday, but my goal here today is to teach you guys what we're going to learn is when will the pain actually stop? And I think I found some insight into that for you. So without further ado, let's get over to it. We're going to figure out when the Federal Reserve might stop, and then I might have good news, actually good news on inflation. So let's get to it. Well, the Federal Reserve yesterday came out, and Federal Reserve Chairman, they came out and increased rates 0.75%. Okay, so we knew that was coming. But our concern was, what are they going to give us with future guidance? So there was two pieces of this puzzle that really confused everybody. So when the Federal Reserve Chairman spoke initially, he came out and said, we're going to raise rates 0.75%. And then he made some comments like, well, we might give this some time to actually settle into the economy and let it work. So that was a dovish tone. So the markets, all of a sudden, as we watched live together, we saw the stock market go up about 200-300 points. We saw mortgage rates plummet. And that was great news. And then all of a sudden, while we were on our live event, we saw the markets completely turn. The Dow Jones went down about 200 or 300 points and mortgage rates spiked. So what happened in that half hour? Well, I got some insight for you. Well, the Federal Reserve came out and they said, okay, maybe we're going to give this time to work. But then during the Q&A session, what he said was this. He said, well, we're going to do everything we need to cure inflation. And that means keep raising rates at an indefinite amount in an indefinite time frame. Okay, but the Wall Street had its own opinions. So what we were following on Wall Street is what exactly was the federal funds rate doing? Okay, so what happens is on Wall Street, the federal funds rate kind of bounces around. And what it did is you could see right here, traders bet the federal funds rate could raise as high as 5.5% before stopping the current rate hike cycle. Okay, but right after the speech, as the markets had time to settle in, the federal funds rate that was trading on Wall Street indicated that rates could or should go up to 4.95%, the federal funds rate. Okay, not mortgage rates, not credit card rates or anything else, the federal funds rate. Well, where is that rate today? Well, that rate is at 4. You can see it right over my shoulder. Let me get my head out of the camera so we can figure out this. So you can see right here, the federal funds rate right now is 4. Just the other day, it was 3.25. So the Federal Reserve raised rates by 0.75%. We were at 0.25% right here just last year. Okay, so how much has they increased rates? They went from 0.25 to 4%. So now the markets are saying, well, this number needs to get to 4.95, as we have represented right here. So let's figure this out. The Federal Reserve has one more meeting this year, all right? So the anticipation is they were going to raise rates another 0.5%. But let's focus in on this. The Federal Reserve or the federal funds rate went when the Federal Chairman Powell spoke, the markets took the federal funds rate all the way up to 5% until settling at 4.9. So this number, as it moves around, let's just assume it takes off another maybe 0.8%. So that would put us at 4.75. Okay, my expectations is at the next meeting, the Federal Reserve is going to raise rates another 0.75%, between 0.5 and 0.75%. Okay, that then should put us right in line where the federal funds rate or the Federal Reserve wants the federal funds rate. So if this is confusing, look at it this way. The Federal Reserve and the markets are saying the federal funds rate should be 4.95. We're at 4% right now. So there's more room the Federal Reserve has to increase rates. Okay, so that's the bad news. How much those increases are going to be, that's the conflicting area right now. I'm saying the next meeting, they're probably going to do 50 basis points because the market's going to digest these numbers that we're seeing today and a lot of other numbers that we're going to go over here in a second. Okay, so another piece of the puzzle is let's look at the inflation front. Let's look at, let's just say you want to buy a loaf of bread, okay? And I know the prices are wrong, but let's say last year a loaf of bread was $1. Okay, so let's say now with inflation out of control, now that a loaf of bread is $2. Okay, so that means the price of bread went up. It actually doubled. It went up 100%. Right. So if you look at that from the time frame, it went from $100 or $1 to $2. It went up 100%. But now we're at the $2 range. Okay, so where we are today. So let's say next year at this time, bread is only $2.10. Okay, so how much of an increase is it? Well, if you look back over 2 years, well, it doubled plus a little bit more. But if you look at it for the past year, it went from $2 to $2.10 or 20 cents, as I just stated. So a very much, a lot lower increase. So just the time that it takes, as time goes on, we're going to see the inflation numbers just by time starting to retract. Now, I know I'm going to have a bunch of naysayers. Please go ahead and put your comments down below, but think about it. That's how a lot of this is going to work. So the next piece of the puzzle we want to go through is let's look at the economic calendar to see what other pieces of the puzzle are taking place today that we can look, maybe give us insight into some forward guidance. So what we have today is, well, let's just recap yesterday. We had the employment numbers from ADP. I'm going to throw those out because it's the first time they did this analysis. They changed all their kind of analyses. So they changed all the way they count the numbers. So I'm really not going to take that into effect. Crude oil inventories are plummeting. We were about 2.5 million barrels in inventory previously. Now we're at 3 million negative. So we're consuming more than we are taking in. That is bad. And oil prices are going up now. And you're starting to see gas prices starting to trickle up too. Here's the federal funds rate. It was at 3.25. Now it's at 4. But let's look at initial jobless claims. The job market right now is the most robust piece of this market. So we have jobless claims, people filing for the first time. It was previously at 218. The expectations were for 220, actually an increase in unemployment, and it actually went down. So the Federal Reserve might be looking at this and saying, we still have more things to do. And then we have the ISM non-factory payroll here, numbers here. Then tomorrow we're going to get the government payroll numbers and the unemployment rate. So this is going to be a huge number tomorrow that we're going to focus in on because the Federal Reserve has two mandates. What are they? One is price stability, and that's AKA inflation. And the other one is full employment. They want to make sure the economy is at full employment. You can't say, well, we're just going to focus in on only one of those areas because you have a dual mandate. Don't forget that, Fed. All right, so based on all this news, what in the heck is going on with mortgage rates? Well, right now, we're seeing the MBS market completely tank. So we're probably going to see mortgage rates go up 1/8 today, and that trajectory is really bad. I'm going to show you that in a minute. But what you're seeing on your screen right now is what's happening to the mortgage bonds on Wall Street. And how I got to explain this is the simplest term. What you're seeing on here is the price of that bond. As the price in this case goes down, there's an inverse relationship with the price and the yields. So as the price goes down, what happens is your rates go up. In this case, or yields go up. In this case, because it's a mortgage bond, your mortgage rates go up. So where are rates at right now? Well, where did they close yesterday? Well, we focus in on Mortgage News Daily. I use their website because it's just an easy teaching tool showing you guys where the national averages are. And here they are. These are the top 6 products people use when they're purchasing or refinancing a house. You can see that right through here, mortgage rates went up about 1/8 yesterday, almost across the board through here on the fixed. And then when you have the government and the arms down here, they went up just a tad. So nothing to really write home about there. But you can see here, we were on a trajectory. Remember on Monday, I said rates might hit back to 6.99 or rate, the 7% mark. We were down from 7.37 where we were, the 52-week high right here, which we just hit not too long ago. Well, now we're on that trajectory up again. So again, what the Federal Reserve did is they came out yesterday and they were a little dovish. And then when they did their Q&A, they did a complete 180, 360, and now they're hawkish. Where they're going to end, I think the federal funds rate needs to get to about 4.75, and the Federal Reserve will be happy. But as long as the jobs numbers don't really tank, we might be in for a little bit of a soft land. So that is my report for today. If you want to find out more about me and my team, all you have to do is go to therateupdate.com, and here it is. What most people do is they book a meeting right here above my head. What you do is you click there and it opens up my calendar, giving all the days that are available where we'll do a one-on-one consultation with you. We have a live chat, as you can see, just popped up behind my head. So if you go on our website and you have a question, just ask it right there. But if you want to call us to learn more and find out what exactly we do, give us a call. 844-775-5626. And don't forget a free service that we have. We now introduced our loan estimate analyzer. What you do is if you got a mortgage quote from another company, please go into our website, go into right here, click it. This is the best way on how you can compare your mortgage applications or your mortgage quotes. And if you want to check out more about that, check out this video right here. It's going to give you a lot of information on how you can do this to find out, are you getting the best rate and terms in the market, or can we do better? So God bless, guys. Thanks so much for watching. I'll see you tomorrow. Take care. Bye-bye.